Thank you. So the recording has started. So let me formally welcome you all in this yet another session on corporate accounting and auditing paper 10 under online coaching system for June 2020 uh, for June 2025 term. Now, already in our previous few sessions, we have completed to a great extent a significant portion of the syllabus of accounting. We covered module 1, module 4, module 5 in detail, and then we decided to start covering the topic from the auditing section. And accordingly, in my previous class, I have covered module 6, that is the very first chapter of auditing. Today, I'm supposed to cover the second chapter of auditing, or actually module 7 of our syllabus. Now, this particular chapter is a bit comprehensive, so what I think that it will take at least 2 days to cover the entire syllabus of module 7. Accordingly, this is going to be our first class on module 7, and on 23rd, the next, we will have another class on module 7. So, with that introduction, let us now start at the class and accordingly share the screen first. I think the screen is visible. So this is actually module 7, provision relating to audit under Companies Act. Basically, this module 7 talks about the provisions relating to statutory auditing, the role of auditor, the qualification, the status, the power, and the duty and responsibilities of audit, and lot more other aspects relating to corporate audit or company audit as per Companies Act 2013. Now, basically, you know that there are certain sources from which the companies they actually source their provisions relating to company auditing. Now, company is a special form of organization, and it is created, maintained, and even winded up through the application of law. In other words, every single operation of a company is subject to certain legal provisions. Accordingly, auditing also is to be guided by certain legal provisions, various acts, rules, and other judicial pronouncements. Now, the sources from which these legal provisions you can actually identify are, first of all, the Companies Act 2013, then various companies rules are there with relevant amendments we should consider. Then we have relevant section of the Chartered Accountants Act 1949. Accounting standards are also there, notified by the Ministry of Corporate Affairs, be it the old accounting standard as per Indian Accounting Standard Rules 2021, or the INDES, that is Indian Accounting Standard as per INDES Rule 2015. Sorry. Now, apart from that, there is various standards, auditing standards issued by the Institute of Chartered Accountants of India, which are to be considered for the purpose of identifying the legal provisions relating to corporate audit. Let us start with the concept of statutory audit first. The term is self-explanatory. The term statutory means anything regulated by law of the state. Accordingly, in an audit which is conducted under any specific statute or act may be called statutory audit. In a company form of organization, the management is actually separated from the ownership, because the owners are the shareholders, but they do not actively take part in the company operations. On the other hand, companies are managed by certain persons known as the managers, and they are guided by the board of directors who are elected by the shareholders. Therefore, the proper utilization of resources procured by the company uh, depends on this managers, and they actually manages the resources in order to achieve the objective of maximization of shareholders' wealth. Therefore, in the context of share management's stewardship, that is their accountability, that must be vouched by some independent third party. In this way, this is why audit of the books or accounts by a qualified and independent auditor has been made mandatory in every company. Now, in order to become eligible to conduct a statutory audit of any company, the auditor is expected to possess certain eligibility, certain qualifications. Now, these qualifications of a company audit, as per Section 141 of the Companies Act 2013, has been specified. As per this Section 141, the following person should be considered as being qualified for being a company auditor. First of all, any person shall be eligible for appointment as an auditor of the company only if he is a chartered accountant as per Section 141, subsection 1 of the Companies Act 2013. Now, who is a chartered accountant? That has been specified in the Chartered Accountants Act. The meaning of the term chartered accountant shall be interpreted based on the provision of the Chartered Accountant Act 1949, and accordingly, chartered accountant means a person who is a member of the Institute of Chartered Accountants of India. The person is a member of the institute if his name appears in the register of the institute as per Section 3 of the Chartered Accountants Act 1949, and uh, the following persons shall be entitled to have their name registered in the chart account in the register of the institute as per Section 4. There, any person who is a registered accountant or holder of a certified restricted certificate at the commencement of the Act of 1942-49, any person who has passed such examination and completed such training as may be prescribed for members of the institute, any person who has passed the examination, the government diploma in accountancy or examination recognized as equivalent thereto by the rules of the award of the government diploma in accountancy before the commencement of the act and fulfills such a condition as specified by the central government in this behalf. And finally, any person who at the commencement of the act is engaged in the practice of accountancy in any state and fulfills such other conditions specified by the central government in this behalf. Now, any person who has passed such other examination and completed such other training without India, uh, as is recognized by the central government or the state council as being equivalent, also they can be a member of the institute. And finally, any person domiciled in India who at the commencement of this act is studying for any foreign examination and at the same time undergoing training whether within or without India, having passed the examination or completes the training within 5 years from the commencement of this Act of 1949, they are eligible to register their name in the register of the Chartered Accountants, Institute of Chartered Accountants, and accordingly, those members are only qualified to act as the company auditor. Now, secondly, a person who also a person instead of a farm instead of an individual, a farm can also be appointed by its farm name to act as the auditor of the company if majority of the partners practicing in India are qualified for appointment as company auditor. And next, where a firm, including a limited liability partnership, is appointed as auditor of a company, only the partners who are chartered accountants shall be authorized to act and sign on behalf of the firm, as per Section 141, subsection 2. Uh, so, what we get is that the company auditor can be an individual, provided he is a chartered accountant. Secondly, a firm, that is a partnership firm of chartered accountants, can also be appointed as the company auditor, and in that case the firm in its firm name will be appointed as the company auditor, provided the members, that is the partners practicing in India, are qualified for appointment as company auditor, and where firm there is an LLP is appointed as an auditor, only the partners who are chartered accountants, they are authorized to sign on behalf of the firm. So that defines the qualification of a company auditor. At the same time, the company that specifies certain disqualification of a company auditor, and any person who is found to satisfy these conditions, he will be disqualified from being a company auditor. Now, this has been specified as per Section 141, subsection 3, and it should be read with Rule 10 of the Company Audit and Accounts Audit and Auditors Rule 2014. And it includes the following person who are not eligible to be appointed as a company auditor. First of all, a body corporate means another company other than a limited liability partnership registered under the Limited Liability Partnership Act. That means LLP can be appointed as an auditor, company auditor, but other than LLP, no other body corporate, no other company can be appointed as a auditor of any company. Secondly, an officer or an employee of the company cannot be appointed as the auditor. A person who is a partner or who is in employment of an officer or employee of the company. That is, say, Mr. X is a partner in a partnership firm where one of the officer or employee of the company also is a partner. In that case, that particular person, Mr. X, is not eligible to be the company auditor of the company in which that other person was employed as an officer or employee. Next, a person who or his relative or partner is holding any security or interest in the company or its subsidiary or its holding company or associate company or subsidiary of such holding company of face value not exceeding rupee 1 lakh. That is, any person holding any security or any interest in the company for 1 lakh or more, either in the particular company or the holding company of the company or the subsidiary of the company or associate of the company, or next in is if the person is indebted to the company or is subsidiary or is holding or associate company or a subsidiary of such holding company in excess of rupees 5 lakh, then the person is not eligible to be appointed as an auditor. Next, if the person has given a guarantee or provided any security in connection with the indebtedness of any third person who to the in third person is the company or its subsidiary or holding or associate company or as a subsidiary of such holding company in excess of rupees 1 lakh. That is, if he has given guarantee for for any person, then also he is not eligible. A person or a firm who, whether directly or indirectly, has business relationship with the company or its subsidiary or holding or associate company or subsidiary of such holding company or associate company of such nature as may be prescribed. Then a person having business relationship directly or indirectly is also not eligible to be the company auditor. For this purpose, business relationship can be interpreted in this way: commercial connections which are in the nature of professional service permitted to be rendered by an auditor or audit under the Companies Act 2013 or Chartered Accountants Act 49 and rules regulation made under this act. So, and commercial transactions which are in the ordinary course of business of the company at the arm's length price, like sale of products or services to the auditor as customer. So in these two cases, it is considered to be business relationship, and person having business relationship directly or indirectly is not eligible to become the company auditor. Next, a person whose relative is a director or is in the employment of the company as a director or key managerial person, or a person who is in full-time employment elsewhere, or a person or a partner of a firm holding appointment as the auditor, if such person or partner is at the date of such appointment or reappointment holding appointment as auditor of the more than 20 companies. So you cannot, there is the auditor, even if he is eligible otherwise, cannot be the appointed as the auditor if he has already reached the limit of 20 companies applicable for him. A person who has convicted by a court of any offense involving fraud and a period of 10 years has not elapsed from the date of such conviction, he is not eligible. And a person who directly or indirectly renders any service referred to in section 144 to the company or its holding company or subsidiary company, he is also not eligible to become the company auditor. Now, when a person appointed as an auditor of a company incurs any of the disqualification mentioned in subsection 3 after his appointment, he shall vacate his office as such auditor, and such vacation shall be deemed to be a casual vacancy in the office of the company audit. Now, section 144 of the Companies Act 2013 as per section 144, as an auditor appointed under this act shall provide to the company only such other services as are approved by the board of directors or the audit committee, as the case may be. However, such services shall not include the following services. That is, the auditor is eligible to provide certain services to the board of directors or the audit committee, but not the following services. Which these services cannot be rendered by any company auditor. Accordingly, if the services are being rendered by a company auditor, then he is eligible. He should vacate his office immediately. Uh, Now, the services include accounting and bookkeeping services, internal audit services, design and implementation of any financial information system, actuarial services, investment advisory services, investment banking services, rendering of outsourced financial services, management services, and any other kind of services as may be prescribed. So that was regarding the qualification and disqualification of company auditor. Now, a qualified auditor must be appointed by the company by following certain well-defined regulation. Now, the appointment of a company auditor is governed by Section 139 of the Companies Act 2030. Now, this appointment related provisions we can broadly discuss into two heads: appointment in normal course and filling up of casual vacancy. In case of appointment in normal course, the provisions are different for appointment of first auditor and appointment of subsequent auditor. And further, the provisions are different for a company other than a government company, as per section 139(6), and for a company who is a government company, owned and controlled by the government, as per section 139(7). Similarly, for appointment of subsequent auditor also, the provisions are different for government company and other than government company. We will discuss each of the provisions in detail one by one, starting with the appointment in the normal course. Now, in the normal course, the appointment of an auditor, the provisions are different for government company and non-government company. First of all, in case of company other than a government company, the first auditor of the company other than a government company shall be appointed by the board of directors within 30 days from the date of registration of the company. In case the board of directors fails to appoint within that such time limit, it shall inform the members of the company, that is the shareholders of the company, who will appoint such auditor within another next 90 days at an extraordinary general meeting. The auditors who are appointed shall hold office till the conclusion of the first annual general meeting. In case of a company auditor, government company, as per section 139 subsection 7, in case of a government company or any other company owned and controlled by either a central government or a state government, or partly by a central government or partly by a state government, one or more state government, the first auditor shall be appointed by the Comptroller and Auditor General of India within 60 days from the date of registration of the company. In case the CAG does not appoint such auditor within the aforesaid period, the board of directors of the company shall appoint such auditor within next 30 days. Further, in the case of failure of the board also to appoint such auditor within next 30 days, it shall inform the member of the company who will appoint such other auditor within 60 days at an extraordinary general meeting. The auditors who are appointed shall hold office till the conclusion of the first AGM. Now, what is the definition of a government company? Now, for the aforesaid purpose, government company shall mean a company in which not less than 51% of the paid of share capital is held by a central government or state government or governments, or partly by central government or partly by one or more state governments, and include a company which is a subsidiary of the government company. So that is the definition of government company. Now coming to the provisions relating to appointment of subsequent auditor. Now, in case of a company other than a government company, section 139(1) and rule 3 and 4 of the audit rules 2014, every company shall at the first AGM appoint an individual or a firm as an auditor who shall hold office from the conclusion of the meeting till the conclusion of the 6th AGM, and thereafter till the conclusion of every 6th meeting. That is maximum 5 years For a maximum of up to 5 years, the appointment can be done. Before such appointment is made, the written consent of the auditor to such appointment and a certificate from him or that audit that the appointment is made shall be in accordance with the Companies Act conditions prescribed shall be obtained from the auditor. Then the certificate shall also indicate whether the auditor satisfies the criteria provided in section 141, and the company shall inform the auditor concerned of his or her appointment, and also file a notice of such appointment with the register within 15 days of the meeting in which the auditor is appointed in Form ABT 1. In case of the government company or any other company owned or controlled directly or indirectly by the central government or by any state government or governments, or partly by the central government and partly by the state government, the Comptroller and Auditor General of India shall, in respect of the financial year, appoint an auditor duly qualified to be appointed as an auditor under this act within a period of 180 days from the commencement of the financial year. The auditor so appointed shall hold office till the conclusion of the annual general meeting. Now coming to the casual vacancies. Appointment in case of filling up a casual vacancy. In case of a company other than a government company, the provisions are as follows. Any casual vacancy will be filled up by the board of directors within 30 days. If such casual vacancy is as a result of the resignation of the auditor, such appointment shall also be approved by the company at a general meeting convened within 3 months of the recommendation of the board, and the auditor so appointed shall hold office till the conclusion of the next AGM. And in case of a company whose accounts are subject to audit by an auditor appointed by CAG, any casual vacancy will be filled up by the Comptroller Auditor General of India within 30 days. And in case of component CAG does not fill up the vacancy within the aforesaid period, the Board of Directors shall fill such vacancy within next 30 days. Now, though not defined clearly, casual vacancy for the aforesaid purpose usually implies cessation of service of an existing auditor due to his death, designation, disqualification, etc. So, on those grounds, the auditor will tender his resignation, and thereafter the office will be filled up as a casual vacancy. Now, reappointment of a company auditor. As per section 139(9), a retiring auditor may be reappointed at an annual general meeting if he is not disqualified for reappointment and if he has not given the company a notice in writing of his unwillingness to be reappointed and a special resolution has not been passed at that meeting appointing some other auditor or providing expressly that he shall not be reappointed, then the auditor will be eligible for reappointment. Automatic reappointment of a company auditor. According to section 139, subsection 10, where at any general meeting no auditor is appointed or reappointed, the existing auditor shall continue to be the auditor of the company. Now coming to the role of the audit committee, the recommendation in appointment of the auditor. Where a company is required to constitute an audit committee under section 177, all appointments, including the filling up of casual vacancy of an auditor under this section, shall be made after taking into account the recommendations of the committee. Now, the ceiling on the number of audit assignments. Now, in order to offer a level playing field, there is a ceiling imposed on the number of assignments that an auditor can accept. Now, as per section 141, subsection 3, clause G, a person or partner of a firm shall not be eligible for appointment as the auditor of a company if such person is in full-time employment elsewhere, or such person or partner is at the date of such appointment or reappointment holding appointment as auditor of more than 20 companies other than one person company, government companies, small companies, and private companies having paid up capital less than 100 crore. Accordingly, the following points shall be kept in mind. Every qualified chartered accountant who is not in full-time employment can be the auditor of a maximum of 20 companies. In case of a partnership fund, the limit will be 20 companies for each individual partner. Therefore, if there are three partners in the fund, the overall limit will be 60 companies. While computing the ceiling in case of partnership fund, a partner with full-time employment elsewhere should not be taken into account. If any chartered accountant is partner in a number of audit firms, then all the firms together will be entitled to audit 20 companies with respect to such common partner. Similarly, if a chartered accountant is practicing individually and is also the partner in other firms, the overall ceiling with respect to him as individual and also as partner will be 20 companies. Next, while calculating the above ceiling, a joint audit assignment will be taken as one unit. Moreover, if the auditor is appointed to audit even a part of the company accounts, it will be considered as one unit. Next, every auditor as an individual or as a partner or a firm can accept maximum of 60 tax audit assignments. If any chartered accountant in practice at any point of time holds appointment of more than specified number of audit assignments of the companies, then he shall be deemed to be guilty of operational misconduct. Now, resignation of a company auditor. According to section 140, subsection 2 of the Companies Act 2013, with rule 8 of the Company Audit and Auditor Rules 2014, a company auditor resigning from his post must comply with the following steps. The auditor shall file within a period of 30 days from the date of resignation a statement in the prescribed form ADT3 with the company and the register indicating the reason and other facts as may be relevant with regard to his resignation. Then, in case of companies referred to in subsection 5 of section 139, government companies or any other company owned or controlled directly or indirectly by the central government or any state government or governments, or partly by the central government and partly by the one or more state government, the auditor shall file such statement. The auditor shall file such statement with the Comptroller Auditor General of India. If the auditor If the auditor does not comply with the above provision, he or it shall be punishable with a fine of 50,000 rupees or the amount equal to remuneration of the auditor, whichever is less. Uh, and in case of continuing failure, with further penalty of 500 rupees for each day after the first, during which such failure continues, subject to a maximum of 2 lakh rupees. Now, rotation of a company auditor. Eligible companies. The provision for rotation of auditor shall be applicable only to some specified companies. Uh, every listed company, excluding excluding 1% company and small companies, every unlisted public company having paid up share capital of rupees 10 crore or more, every private limited company having paid up share capital of rupees 50 crore or more, and all other companies having public borrowing from financial institutions, banks, or private or public deposits of rupees 50 crore or more. So, for these companies, actually the rotation of company auditor will apply. Now, the maximum term, no individual shall be appointed or reappointed as auditor for more than one term of 5 consecutive years. No audit firm shall be appointed or appointed as auditor of more than 2 terms of 5 consecutive years. Additional consideration: an individual auditor or an audit firm who or which has completed his term shall not be eligible for reappointment as auditor in the same company for 5 years from the completion of such term. That means there will be a cooling period of 5 years. On the date of appointment, no audit firm having a common partner or partners to the other audit firm whose tenure has expired in a company immediately preceding the financial year shall be appointed as auditor of the same company for a period of 5 years. Uh, this is for the fund. Then every company existing on or before the commencement of this act, which is required to comply with provision section 139(2), shall comply with the requirement of this subsection within a period which will not be later than the date of first AGM of the company held within the period specified in 96(1) section after 3 years from the date of commencement of the Companies Act. The above provision shall not prejudice the right of the company to remove an auditor. That is, if even if rotation is applicable, the auditor company can at any point of time remove an auditor, and or the right of the auditor to resign from such office of the company. Now, rotation of partners in the audit firm. According to section 139 subsection 3, the members of a company may resolve to provide that in the audit firm appointed by it, the auditing partner and his team shall be rotated at such interval as may be resolved by the members, or the audit shall be conducted by more than one auditor. The manner of rotation of auditors by the companies on expiry of their term. As per section 139 subsection 4, the central government may by rules prescribe the manner in which the company shall rotate their auditors in pursuance of section 139 subsection 2. Accordingly, the central government has prescribed the following provisions under Rule 6 of the Companies Audit and Auditor Rule 2014, where an auditor is required to constitute an audit committee under section 177 of the Act. The audit committee shall recommend to the board the name of an individual auditor or of an audit firm who may replace the incumbent auditor on expiry of the term of such incumbent. And where a company is not required to constitute an audit committee under section 177 of the Act, the board shall consider the matter of rotation of auditor and make its recommendation for appointment of the next auditor by the member in the annual general meeting. Now, for the purpose of rotation, the period for which the individual or the firm has held office as auditor prior to the commencement of this Act shall be taken into account for calculating the period of 5 consecutive years or 10 consecutive years for the firm. The incoming auditor of the audit firm shall not be eligible if such auditor or audit firm is associated with the outgoing auditor or audit firm under the same network of audit firm. And the term same network shall include the firms operating or functioning hitherto on in future under the same brand name, trade name, or common control. Now, for the purpose of rotation, a break in the term of continuous period of 5 years shall be considered as fulfilling the requirement of rotation. And if a partner who is in charge of an audit firm and also certifies the financial statement of the company retires from the said firm and joins another firm of chartered accountant, such other firm shall also be eligible to be appointed as a period of 5 years. Now, the remuneration. Section 142 of the Companies Act 2013 contains the statutory provisions relating to the remuneration of auditors, and these are as follows. First of all, the remuneration of the auditor of the company shall be fixed at the general meeting or in such manner as may be determined therein. The board may, however, fix remuneration of the first auditor appointed by it. The above remuneration shall be in addition to the fee payable to an auditor and shall include the expenses, if any, incurred by the auditor in connection with the audit of the company and any facility extended to him. However, it must not be including any remuneration paid to him for any other service rendered by him at the request of the auditor, at the request of the company. So, the remuneration should be the fee payable, which is payable compulsorily to the auditor, and in addition to that, remuneration shall also include the expenses, if any, incurred by the auditor on behalf of the company in connection of the audit of the company and facility extended to him. However, the remuneration must not include any remuneration paid to him for any other service rendered by him at the request of the companies. That will be separately treated. Removal of the company auditor. According to Companies Act 2013, A company auditor can be removed from his office in two ways. First of all, removal of the company auditor before expiry of this term, and removal of the auditor by tribunal. Removal of the auditor before expiry of this term. The auditor appointed under Section 159 may be removed from his office before the expiry of his term, subject to the fulfillment of the following conditions under Section 140, subsection 1, read with Rule 7 of the CAAR 2014. Next, the application shall be made to the central government within 30 days of the resolution passed by the board. The company shall hold the general meeting within 60 days of the receipt of the approval of the central government for passing the special resolution for removal of the said auditor. The auditor concerned shall be given a reasonable opportunity of being heard. Then, removal by tribunal. As per section 140, subsection 5, an auditor can be removed from his office by the tribunal in the following manner. The tribunal, either suo motu or on an application made by the central government or by any person concerned, may by order direct the company to change its auditor if it is satisfied that the auditor has, whether directly or indirectly, acted in a fraudulent manner or abetted or colluded in any fraud by or in relation to the company or its directors or officers. And if the application is made by the central government and the tribunal is satisfied that any change in the auditor is required, it shall, within 15 days of receipt of such application, make an order to the removal of the auditor from his uh, office. The central government may appoint other auditor in his place. An auditor, whether individual or firm, against whom final order has been passed by the tribunal under this section, shall not be eligible to be appointed as an auditor of the company for a period of 5 years from the date of passing of such order, and the auditor shall also be liable for action under section 447. For this purpose, the word auditor shall include a firm of auditors also. Moreover, in case of a firm, the liability shall be of the firm and that of every partner or partners who acted in a fraudulent manner or abetted or colluded in a fraud or in relation to the company or its directors or officers. So, uh, these were the provisions relating to the removal of the auditor. Coming to the rights and duties of company auditor. Rights of the company auditor. Effective discharge of duties on the part of the auditor requires certain rights and powers which are legally protected. Accordingly, Companies Act 2013 provide the following statutory rights to the company auditor. First of all, inspect books of accounts and vouchers. Every auditor of a company shall have the right of access at all times to the books of accounts and vouchers of the company, whether kept at the registered office of the company or any other place. In addition, auditor of a holding company shall also have the right to access the records of all the subsidiaries and associate companies insofar as it relates to the consolidated financial statement with that of its subsidiary. So not only of the main company, but also of all the subsidiary associate companies records can be inspected by the auditor. Obtain information and explanation. The auditor shall be entitled to require from the officers of the company such information and explanation as may be necessary, considered necessary for the performance of his duties as the auditor. Next, branch officer accounts. The company auditor is also entitled to inspect the accounts of any branch office in case he considers it necessary in order to discharge his duty as the company auditor. He can do so even if a separate auditor has already been appointed to audit the branch accounts. Next, uh, to receive the report of the branch audit from the branch auditor. In case a separate auditor has been appointed to audit the branch accounts, the company auditor has the right to receive the branch audit report from the branch auditor, so appointed, and use it to prepare the overall audit report. Next, sign the audit report and other documents. The company auditor also has the right to sign the auditor's report or sign or certify any other document of the company in accordance with the provision of the subsection 2 of section 141. Next, have an audit report read at the AGM. If the company auditor has the right, if the company auditor has the right to have the report read before the company in the general meeting, especially in case of qualifications, observations, or comments on financial state transactions or matters mentioned in the auditor's report having adverse effect on the functioning of the company, and the same shall be open to inspection by any member of the company. Receive notices. The company auditor is entitled to receive all notices of and other communications relating to any general meeting and to attend such meeting either by himself or through his authorized representative, who shall also be qualified to be an auditor. The auditor shall also have the right to be heard at such meeting on any part of the business which concerns him as the auditor. Next, attend the meeting of the audit committee. The auditor of a company meeting of the audit committee and to be heard in the meetings when the committee considers the auditor's report, but shall not have the right to vote. Next, right to be indemnified. If the auditor of the company shall also have the right to be indemnified for any expenses incurred by him in defending himself in case the judgment in any in case the judgment in any lawsuit, whether civil or criminal, against the company goes in favor of the auditor. Now, the above rights of the company auditor are protected by law, and no clause of the article of the association of the companies or resolution, article of association of the company or a company resolution adopted in any meeting can supersede them. Now, coming to the duties of the company auditor, Companies Act 2013 provides a comprehensive list of duties of a company auditor. These are, first of all, duty to inquire. As per section 143(1), subsection 1, it is the duty of the auditor to inquire into the following matters: whether loans and advances made by the company on the basis of scrutiny, of the basis of the security, has been properly secured, and whether the terms of which they have been made are prejudicial to the interest of the company. Secondly, whether transactions of the company which are represented merely by book entries are prejudicial to the interest of the company. In case of a company other than an investment company or banking company, whether so much of the assets of the company as consist of shares, debentures, or other securities have been sold at a price less than that at which they are purchased by the company, and whether loans and advances made by the company have been shown as deposits, whether personal expenses have been charged to the revenue account, and whether it is stated in the books of accounts and documents of the company that any shares have been allotted for cash or otherwise cash has actually been received in respect of such allotment, and if no cash has actually been received, so whether the position as stated in the account books and balance sheet is correct, regular, and not misleading. Now, duty to report on financial statement to the company. As per section 143, subsection 2, the auditor shall make a report to the members of the company on the accounts examined by him and on every financial statements which are required by or under this act, after taking into account the provision of this act, the accounting and auditing standard, etc. Additionally, he shall also report whether in his opinion and according to the best of his information and knowledge, the said accounts, financial statements give a true and fair view of the state of the company's affairs as at the end of the financial year, and profit or loss and cash flow for the year. Next, duty regarding inclusion of criteria of certain matters in the audit report. As per section 143.3, the auditor's report should also clearly state whether he has sought and obtained all the information and explanation which, to the best of his knowledge and belief, were necessary for the purpose of the audit, and if not, the details thereof and the effect of such information on the financial statement. Secondly, whether, in his opinion, proper books of accounts as required by the law have been kept by the company and proper returns adequate for the purpose of his audit have been received from the branches not visited by him. Thirdly, whether the report on account of any branch office of the company audited by a person other than company's auditor has been sent to him and the manner in which he has dealt with it in preparing his report. Next, whether the company's balance sheet and profit and loss account dealt with the report dealt with in the report are in agreement with the books of accounts and returns, and whether, in his opinion, the financial statement comply with the accounting standards. The observation or comment of the auditor on financial transactions or matters which have any adverse effect on the functioning of the company, and whether any director is disqualified from being appointed as a director under subsection 2 of section 164. Next, any qualification, reserve, or adverse remark relating to the maintenance of accounts and other matters connected therewith, and whether the company has adequate internal financial control with respect to financial statement in place and operating effectiveness of such control. The auditor's report shall also include his views and comments on the following matters: whether the company has disclosed the impact, if any, of pending litigation on its financial position, whether the company has made provision as required under any law or accounting standard for material foreseeable losses, whether there has been any delay in transferring amount required to be transferred to the Investor Education and Protection Fund by the company, and whether the management has represented that to the best of its knowledge and belief, other than as disclosed in the notes to the accounts, no funds have been advanced or loaned or invested by the company to or in any other person or entities, including foreign entities, with the understanding whether recorded in writing or otherwise, that the intermediary shall, whether directly or indirectly, lend or invest in other persons or entities identified in any manner whatsoever by and on behalf of the company, or provide any guarantee, security, or like on behalf of the ultimate beneficiaries. Then whether the management has represented that, to the best of its knowledge and belief, other than as disclosed in the notes to accounts, no funds have been received by the company from any person or entity, including foreign entities, with the understanding, whether recorded in writing or otherwise, that the company shall, whether directly or indirectly, lend or invest in other persons or entities identified in any manner whatsoever, or by or on behalf of the funding party, or provide any guarantee, security, or the like on behalf of the ultimate beneficiaries. And next, based on such audit procedure that the auditor has considered reasonable and appropriate in circumstances, nothing has come to their notice that has caused them to believe that the representations contain any material misstatement, and whether the dividend declared or paid during the year by the companies in compliance with section 123 of the Companies Act 2013, whether the company in respect of financial year commencing on or from 1st April 22 has used such accounting software for maintaining its books of accounts, which has a feature of recording audit trail, that is edit log facility, and that the same has been operated throughout the year for all transactions recorded in the software, and audit trail feature has not been tempered with the audit trail has and with the audit trail has been preserved by the company as per the statutory requirements of record retention. Next, duty to provide reason for any negative remark. According to section 143.4, where any of the above-mentioned matters required to be included in the audit report is answered in a negative or with a requalification, the report shall state the reason thereof. Next, duty to comply with the direction of CAT. As per section 143 subsection 5, in case of a company, government company or any other company owned and controlled directly or indirectly by central government or in state government or partly by the central government, partly by the one or more state governments, the auditor shall in his report include the directions, if any, issued by the CAG regarding the manner of audit accounts and the action taken on such directions and other directions and its impact on the accounts and financial statement of the company. Next, duty to comply with auditing standard. As per section 143 subsection 9, it is the duty of every company auditor to comply with the applicable auditing standard in conduct of his audit. Then duty to report any fraud to the central government. According to section 143 subsection 12, read with rules 13 of the Company Audit and Auditors Rules 2014, if an auditor of a company in the course of his performance of duties as statutory auditor has reason to believe that an offence or fraud which involves or is expected to involve individually an amount of rupees 1 crore or above is being or has been committed against the company by its officers or employees, the auditor shall report the matter to the central government. The auditor shall report the matter to the central government as under. The auditor shall report the matter to the board of the audit committee as the case may be immediately, but not up later than 2 days of his knowledge of the fraud, seeking their reply or observation within 45 days. On receipt of such reply or observation, the auditor shall forward his report and the reply or observation of the board or the audit committee along with his comments on such reply or observation of the board of the audit committee to the central government within 15 days from the date of receipt of such reply or observation. As the case, or in case the auditor fails to get any reply or observation from the board or the audit committee within a stipulated period of 45 days, he shall forward his report to the central government along with the note containing the details of his report that was earlier forwarded to the board or the audit committee for which he has not received any reply or observation. Next, the report shall be sent to the Secretary, Ministry of Corporate Affairs in a sealed cover by the registered post with acknowledgement due or by speed post, followed by an email in confirmation of the same. The report shall be on the letterhead of the auditor containing postal address, email address, and contact telephone numbers. And the papers must be signed by the auditor with his seal and shall indicate his membership number. Next, the report shall be in the form of a statement as specified in form number ADP 4, and in case of a fraud involving lesser than the amount specified in sub-rule 1 of the auditor shall report the matter to the audit committee constituted under 177 to the board immediately but not later than 2 days of his knowledge of the fraud, and he shall report the matter specifying the following: the nature of the fraud with description, approximate amount involved, parties involved. The provision of this section regarding the duty of an auditor shall also apply to the cost accountant conducting cost audit under section 148 and the company secretary in practice conducting secretarial audit under section 204. Duty to pay penalty. As per section 143 subsection 15, if any auditor, cost accountant, or company secretary in practice fails to comply with the provision of subsection 12 of the section 143, he will be liable in case of a listed company to pay the penalty of 5 lakh rupees, and in case of any other company to pay a penalty of 1 lakh rupees. Then duty to make comments sought by the audit committee on certain matter. According to section 177 subsection 5, It is the duty of the company auditor to offer comments on internal control system, the scope of audit, including the observation of the auditor and reviews of the financial statement, if asked by the audit committee. Other duties under Companies Act 2013. In addition to the above, the auditor shall have the following duties: to report on the accounts of the company, which will be included in the proportion in the prospectus of the company while issuing new shares, and to sign the audit also is a duty. Next comes the liabilities of the company audit. The duties of a company auditor have been specified in various provisions of the Act. Accordingly, if a company auditor fails to discharge his specified duties, he will be legally held liable. Moreover, there are a number of occasions where an auditor may be held liable to his appointing authority, the auditor, the government, or any other persons. The liabilities may be defined and discussed as follows. Statutory liability under Companies Act 2013. There are certain civil liabilities. For misstatement in the prospectus, first of all, as per section 35, where a person has subscribed for the security of a company acting on any statement included in the prospectus, or on the inclusion or omission of any matter in the prospectus which is misleading and thereby has sustained any losses or damage, and where the auditor as an expert has either made such statement or has given written consent to the issue of the prospectus, he shall be held liable. Liability for misfeasance. Misfeasance implies breach of trust or negligence in the performance of the duty as per section 340. A company auditor may be charged with misfeasance only at the time of liquidation of the company if it is found that he has misapplied or retained or become liable or accountable for any money property of the company and has been guilty of any misfeasance or breach of trust in relation to the company. So these were the civil liabilities and the criminal liabilities. The criminal liabilities of an auditor under the Companies Act 2013 are as follows. Criminal liability for misstatement in the prospectus. As per section 34, where the auditor has authorized the issue of any prospectus which includes any statement which is untrue or misleading, or where the prospectus has included or omitted any matter which may mislead the audit, which may mislead, the auditor shall be held liable as per section 447. Accordingly, section 447, for any fraud involving an amount of at least 10 lakh rupees or 1% of the turnover of the company, whichever is lower, the auditor shall be punishable with an imprisonment for an amount for a term which shall not be less than 6 months, but which may extend to 10 years, and shall also be liable to pay a fine which shall not be less than the amount involved in the fraud, but which may extend to the 3 times the amount involved in the fraud. Moreover, where the fraud in question involves public interest, the term of the imprisonment shall not be less than 3 years. However, where the fraud involves an amount less than 10 lakh rupees and 1% of the turnover of the company, whichever is lower, and does not involve public interest, any person guilty of such fraud shall be punishable with an imprisonment of a term which may extend to 5 years, or with fine which may extend to 50 lakh rupees or both. Next comes punishment for non-compliance with section 139, 44, 45 of the Act. If an auditor contravenes the provision of section 139, 144, or 145, he shall be punishable with fine which shall not be less than 25,000 rupees, but which may extend to 5 lakh or 4 times the remuneration of the auditor, whichever is less. If an auditor has contravened the above provision knowingly or willfully with the intention to deceive the company or its shareholder or creditor or tax authorities, he shall be punishable with an imprisonment of a term which may extend to rupees 25 lakhs or 8 times the remuneration of the auditor, whichever is less. Convicted auditor shall be liable to refund the remuneration received by him from the company and pay the damages to the company, statutory bodies or authorities, or to the members or creditors of the company for loss arising out of incorrect or misleading statement of particulars made in this audit report. Now, in case where the auditor of the company is being conducted by an audit firm, it is proved that the partner or partners of the audit firm has acted in a fraudulent manner or abetted or colluded in any fraud or in relation to the company or director or officers, the partner or partners concerned of the audit firm as well as the firm itself shall be eligible for fine jointly and severally. However, the criminal liability other than fine only, the partner or partners will be liable. Now, punishment for refusal or failure to produce documents. As per section 217, if any auditor fails without reasonable cause or refuses to produce to an inspector or any person authorized by him on his behalf any book or proper book or paper or to furnish any information to appear before the inspector personally when required or to answer any question which is put to him by the inspector or to sign the notes of any examination referred to in subsection 7 of section 217 shall be punishable with imprisonment for a term which may extend to 6 months and with fine ranging from 25,000 to 1 lakh rupees, and also with further fine which may extend to 2,000 rupees for every day after the first, during which the failure or refusal continues. Next, fraud in relation to a company winding up. As per section 336, if any auditor is engaged in any fraudulent activities in relation to the company in winding up, he shall be punishable with imprisonment for a term which shall not be less than 30 years, not than 3 years, but which may extend to 5 years, and with fine which shall not be less than 1 lakh, but which may extend to 3 lakh rupees. Punishment for false statement. As per section 448, if any auditor deliberately makes a false statement in any return, report, certificate, financial statement, or prospectus, or statement or other documents required by the Act, or deliberately omits any material fact, he shall be liable under section 1447 and shall be subject to the punishment as stated earlier in point number 8. Punishment for false evidence. As per section 449, if the auditor intentionally gives false evidence upon any examination, on oath, or sworn affirmation, or in any affidavit, deposition, or sworn affirmation in or about the winding up of a company or about about any matter under the Act, he shall be punishable with imprisonment for a term which shall not be less than 3 years, but which may extend to 7 years, and with fine which may extend to 10 lakh rupees. Now, liability under other Act, Income Tax Act 1961, as per section 278 of the Act, if any auditor abets or induces in any manner another person to make and deliver an account, statement, or declaration relating to any income chargeable to tax which is false and which the auditor either knows or does not believe to be true, the auditor shall be punishable. Liabilities under Chartered Accountants Act 1949, Schedule 1 and 2 of the Chartered Accountants contains the list of instances where chartered accountants shall be held guilty of professional misconduct under section 22 of the Act. Life Insurance Act 1956, section 104 of the Act, if any auditor makes a false statement in return report or other such forms to be issued under this Act, he shall be sentenced to imprisonment or fine or both. Liabilities under Banking Regulation Act 1949, as per section 46 of this Act, if an auditor in any return, balance sheet, or other documents willfully makes a statement which is false in any material particulars, knowing it to be false, or willfully omits it to make a material statement, he shall be held liable. So these were his liabilities, civil or criminal liabilities. There are certain contractual liabilities also. The scope of any audit work is determined by the written contract entered into between the auditor and the client. Thus, if any of the terms of the said contract is contravened, the auditor shall be held liable under Companies Act 1872. In case of absence of any written contract between the auditor and the appointing authority, the auditor is expected to conduct complete audit. Hence, if in such a circumstance he conducts only partial audit and any error or fraud is discovered later on, he shall be held liable. Moreover, an auditor shall also be held liable if he discloses any secret information of the client to any third party. In the case of Wild and others versus Kip and Dalglish, 1897, also it was held that if the client suffers any loss due to the auditor not complying with the contract, and the auditor will have to compensate the client for such loss. Now let us come to branch audit. Section 128, subsection 1 of the Companies Act 2013 provides that every company shall prepare and keep at its registered office books of accounts and other relevant books and papers and financial statements of every financial year, which give a true and fair book of view of the state of affairs of the company, including that of the branch office and officers, branch office and offices, if any, and explain the transactions affected both at the registered office and its branches, and such books shall be kept on accrual basis and according to the double entry system of the company. The board of directors may, however, decide to keep all or any of the aforesaid books of accounts and other relevant papers at such other place in India. In such circumstances, company shall within 7 days thereof file with a registered notice in writing giving the full address of that other place. Section 128, subsection 2 further specifies that where a company has a branch office in India or outside, it shall be deemed to have complied with the provision of section 128, subsection 1. If proper books of accounts relating to the sections relating to the transactions effected at the branch office are kept at that office, and proper summarized return periodically are sent by the branch office to the company at its registered office or other place as decided. Hence, given the provision of section 128, 1 and 2, there arises the scope of auditing the records of the transactions effected at the branch office in India or outside India, whether such records are kept in the registered office, branch office, or other place. Accordingly, section 143(8) of the Companies Act 2013, read with Rule 12 of CAAR 2014, states the following provisions relating to the accounts of a branch office of the company. Where a company has a branch office, the accounts of that office shall be audited either by the auditor appointed by the company, that is the company auditor, under this act, or any other person qualified for appointment as an auditor of the company under this act and appointed as an as such under section 139. Where the branch office is situated in a country outside India, the accounts of the branch office shall be audited either by the company's auditor or by an accountant or by another person duly qualified to act as an auditor of the accounts of the branch office in accordance with the laws of the company. The duties and power of the company's auditor with reference to the audit of the branch office and branch auditor, if any, shall be contained in subsection 1 to 4 of the section 143. Similarly, if the branch office is appointed separately, the duties and powers of the branch office shall be as same as applicable to the company auditor under subsection 1 to 4 of this act. The branch auditor shall submit his report to the company auditor, and provisions of subsection 12 of the section 143 regarding reporting of fraud by the auditor shall also extend to the branch auditor to the extent it relates to the concerned branch. Now comes the concept of joint audit. What is joint audit? Joint audit refers to the process of conducting the audit of a single organization by more than one auditor. So simultaneously 2 or 3 auditors, when they are doing audit work in a company, then it is called joint audit. Large companies with diversified business operations often resort to this process of auditing, where they employ multiple auditors to conduct statutory audit. The basic aim in applying joint audit, is to pool the resources of multiple auditors to conduct and efficiently and within lesser one amount of time. Then benefits of joint audit. The benefits of joint audit are as follows. Joint audit reduces the workload of a single auditor because there are multiple auditors involved. Since different auditors may be engaged to handle different parts of accounts, timely completion of the work is possible. Thirdly, the auditors may share their expertise and solve critical problems in process. Joint audit improves the quality of audit work to a great extent. There may be healthy competition among the auditors, which improves the quality and speed of the audit work. Under joint audit, it is possible to get the benefit of extensive knowledge of different auditors at the same time. Limitations of joint audit. There are certain limitations of joint audit also. First of all, established auditors may have a superiority complex over the less experienced one. It is not suitable for a small organization due to substantial cost for a small entity due to substantial cost burden. At times, lack of coordination among the auditors may slow down the speed of work. There may be uncertainty about the liability of any work, who will take the liability. Areas of common concern may be neglected. The auditors have no share, or the auditors have to share the fees. Now, guidance on joint audit. SA 299 responsibility of joint auditor has prescribed the following guidelines with regard to the joint audit. Number one, division of work. Where joint auditors are appointed, they should, by mutual discussion, divide the audit work among themselves. The division of work should usually be in terms of audit of identifiable units or specified areas. In some cases, due to nature of the business of the entity under audit, such a division of work may not be possible. Next, in such situations, the division of work may be with reference to items of assets or liabilities or income or expenditure, or with reference to periods of time. Certain areas of work, owing to their importance or owing to the nature of the work involved, would often not be divided and would be covered by all the joint auditors. The division of work among joint auditors, as well as areas of work to be covered by all of them, should be adequately documented and preferably communicated to the entity. Next is coordination, where in the course of the work, a joint auditor comes across matters which are relevant to the areas of responsibility of other joint auditors, and which deserves their alteration, or which requires disclosure or require discussion with, and or application of judgment by or other joint auditors, he should be he should communicate the same to the other joint auditor in writing, and this could be done by the submission of a report or note prior to the finalization of the audit. Relationship among joint auditor and their responsibilities. In respect of audit work divided among the joint auditors, each joint auditor is responsible only for the work allocated to him. Whether or not he has prepared a separate report on the work performed by him. On the other hand, all the joint auditors are jointly and severally responsible in respect of the audit work which is not divided among the joint auditors and is carried out by all of them. In respect of decision taken by all the joint auditors concerning the nature, timing, and extent of the audit procedure to be performed by any of the joint auditors, it may, however, be clarified that all the joint auditors are responsible only in respect of appropriateness of the decisions concerning the nature, timing, and extent of the audit procedure agreed upon among them. Proper execution of these audit procedures is the separate and specific responsibility of the joint auditor concerned. In respect of matters which are brought to the notice of the joint auditor by any one of them and on which there is an agreement among the joint auditors. For examining that the financial statement of the company comply with the disclosure requirement of the relevant statute, and for ensuring that the audit report complies with the requirement of the relevant statute. If any matters of nature referred in B above are brought to the attention of the entity or other joint auditors of the company after the audit report has been submitted, the third joint auditors would not be responsible for those matters. Now, dependence on other auditors. Each joint auditor is entitled to assume that the other joint auditors have carried out their part of the work in accordance with the generally accepted audit principle. It is not necessary for a joint auditor to review the work performed by the other joint auditor or auditors or perform any tests in order to ascertain whether the work has actually been performed in such a manner. Each joint auditor is entitled to rely upon the other joint auditors for bringing his notice and departure from the generally accepted accounting principles or any material error noticed in the course of the audit. Reporting responsibility. Normally, the joint auditors are able to arrive at an agreed report. However, where the joint auditors are in disagreement with regard to any matter to be covered by the audit report, each one of them should express his or her opinion through a separate report, and a joint auditor is not bound by the views of the majority of the joint auditors regarding matters to be covered in the audit report and should express um, his opinion in a separate report in case of a disagreement. Now, in audit work of any company, audit committee plays a very important role. Now, what is audit committee? Regulators across the world have suggested strict corporate governance codes to minimize the corporate frauds by the management. Since an independent audit report may to a great extent reveal the existence of frauds in corporate accounts, ensuring ensuring independence of audit can significantly help in enhancing free conduct of good governance. Now, in order to ensure that the governance codes have been designed to incorporate a number of regulations to ensure auditors' independence, elimination of the scope of any conflict of interest or part of the auditor as consultant, review of the auditor's performance, etc., by establishing a separate committee known as the audit committee. The concept of audit committee is not new in India. Clause 49 of the listing agreement as issued by SEBI had specified such requirement long ago. However, such requirement was limited to only listed companies and not for all companies. The new Companies Act 2013 has broadened the scope further by bringing it in the purview of the Act. Now, provision regarding audit committee, formation of the committee. As per section 177, subsection 1, reviewed companies meeting of the board and its power rule 2014, the board of directors of every listed company and the following classes of companies shall constitute an audit committee. All public companies with a paid-up capital of 10 crore or more, all public companies having turnover of 100 crore rupees or more, and all public companies having an aggregate outstanding loan or advance, loan or borrowing or debenture or deposit exceeding 50 crore or more. So, on these occasions, on these companies, constitution of the board of committee will be required. Now, the composition. The audit committee shall consist of a minimum of 3 directors with independent directors forming a majority. Moreover, majority of members of the audit committee, including its chairperson, shall be with ability to read and understand the financial statements, section 177, subsection 2. Broad function of audit committee. As per section 177, subsection 4 of the Companies Act 2013, the board shall specify in writing the terms and reference of the audit committee, which shall inter alia include The recommendation for appointment, remuneration, and terms of the appointment of the auditor of the company, review and monitor the auditor's independence and performance effectiveness of audit procedure, examination of financial statement and auditor's report thereon, approval or any subsequent modification of the transactions of the company with relating to parties, scrutiny of intercorporate loans and advances, loans and investments, valuation of undertakings or assets of the company, whichever is necessary, and so on. Power of the board of power of the audit committee. Committee may ask for auditor's comment. The audit committee may call for the comments of the auditors about internal control system, the scope of the audit, the observations of the auditors, and review of financial statement before their submission to the board. The committee may also discuss any related issues with the internal and statutory auditor and management of the company. Next, investigation. The audit committee shall have the authority to investigate into any matter in relation to the items specified in 177.4 or referred to it by the board. For this purpose, the committee shall have power to obtain professional advice from external sources and have full access to information contained in the records of the company. Board's report and audit committee. The board's report under subsection 3 of section 134 shall also disclose the composition of the audit committees, and where the board has not been accepted any remuneration of the audit committee, the same shall disclose in such report along with the reasons thereof. Therefore, then whistleblowing policy. Every listed company and company accepting public deposits or borrowing in excess of 50 crore rupees from bank or financial institutions shall establish a vigil mechanism for directors and employees to report genuine concerns in such matter as may be prescribed. Safeguards against victimization. The vigil mechanism under subsection 9 shall provide for adequate safeguard against victimization of persons who use such mechanism, and make provision for direct access to the chairperson of the audit committee in appropriate or exceptional cases. The company shall disclose establishment of such mechanism on its website, if any, and in the board's report. Let us skip this portions. Okay, these are certain case studies. Messrs. ABC and Company is an audit firm having partners A, B, and C. All of them are qualified chartered accountants. The firm has offered the appointment as a company auditor of X Limited for the year 2021. Mr. P, a relative of Mr. A, is holding holding 4,000 shares, face value 10 rupees in X Limited, having market value of 1,75,000. As a legal expert, advise ABC Company. As per section 143, subsection 1, clause D, a person shall not be eligible for appointment as an auditor of a company who or his relative or partner is holding any security or interest in the company, or its subsidiary or its holding company, associate company, or subsidiary company of such holding company. However, as per provision of this section, the relative of a person may hold security or interest in the company of face value not exceeding 1 lakh. In the given case, Mrs. ABC Company is an audit firm having partners A, B, and C. Mr. P is a relative of Mr. A and is holding shares of X Limited of face value 60,000 only. Therefore, Mrs. ABC and Company is not disqualified for appointment as an auditor of X Limited, as relative of Mr. A is holding the securities in X Limited, which is within the limit mentioned in provisions to section 141, subsection 3 of the Companies Act 2013. This case is important. XYZ and Company is an audit firm having partner X, Y, and Z chartered accountants. X, Y, and Z are currently holding appointment as an auditor in 3, 5, and 9 companies respectively. The firm has asked you for your legal expertise to suggest the following. First of all, the maximum number of audits remaining in the name of XYZ company as per section 143 C subsection G of the Companies Act 2013. A person or a person or a partner of a firm shall not be eligible for appointment as the auditor of the company if such person is in full-time employment elsewhere, or such person or person is at the date of appointment or reappointment holding appointment as auditor of more than 20 companies other than a person companies, dormant companies, small companies and private companies having bid of capital less than 100 crore. In the given case, the firm is having three partners, A, B, and C, and accordingly, the overall ceiling is 3 into 20, that is 60 companies audits. Since the three partners in their individual capacity currently holds 3.9, that is 17 companies, the firm is eligible to be appointed as the auditor for the remaining 43 companies, 60 minus 17. The partners in their individual capacity are eligible to the following maximum additional number of companies. Mr. X 20 minus 3 is 17, Y is 15, and Z 11. Thirdly, since audit assignments in dormant companies, small companies, and private companies having paid up capital less than 100 crore are excluded from the above ceiling, the firm XYZ and company can accept the appointment as an auditor in 55 private companies having paid up capital of less than 100 crore, 3 small companies, and 2 government companies. Next, if 45 companies out of 55 companies are having paid up capital of 105 crore each, the firm will be eligible to accept appointment in only 43 such companies. Okay. Now, so far we have discussed about the statutory audit and related provision. Now we are coming to cost audit. Concept and definition of cost audit. In a competitive business world, decisions on pricing policy, product mix, service mix, utilization of IT capacity, etc., often requires dependable cost data. Hence, an independent and critical appraisal of the cost records and cost accounts is imperative. First, audit is the independent and critical examination of the cost data to authenticate the results relating to ascertainment of cost and adherence to the available regulatory guidelines. Now, according to the Institute of Cost Accountants of India, Cost and Management Accountants of England, cost audit represents the verification of cost accounts and a check on the adherence to cost accounting plan. Cost audit therefore comprises verification of cost accounting records such as accuracy of the cost account, cost reports, cost statement, and cost data, and costing techniques. Examination of these records to ensure that they adhere to the cost accounting principles, planning procedure, and objectives. According to the History of Cost Accounts in India, cost audit is an independent examination of cost and other related information in respect of a product or group of products of an entity, whether profit oriented or not, irrespective of its size or legal form, and when such an examination is conducted with a view to expressing an opinion thereon. Importance of cost audit. Cost audit provides authenticate data on cost data, and thereby it helps in making decisions on pricing policy, product mix, outsourcing, discontinuation of product. There is different managerial decisions. On different managerial decisions, cost audit actually provide meaningful information and help the management in taking decision in that context. Then cost audit identifies the inefficiencies and thereby helps in improving the productivity. Organization, if it is having certain non-value adding activities that can be identified by this cost audit, and thereby that can be eliminated to improve the productivity. Next, cost audit helps in ensuring the optimum utilization of limited resources. The benefits are extended to the customers. Cost audit appraises the cost control mechanism followed in an organization. Cost audited data audit may form the basis of determining the standard cost data. And government, after decides on extending or abolishing tariff protection based on audited data on cost structure of the company. Now, the very important one, regulatory framework of cost auditing. Section 148, one of the Companies Act 2013, authorizes the central government to make it mandatory by order the maintenance of cost records relating to utilization of material or labor or to other items of cost as may be prescribed for certain class of companies. Section 148, subsection 2, also empowers the central government to issue orders to make audit of cost records of above mentioned companies mandatory. Accordingly, the Ministry of Corporate Affairs issued the company's cost records and audit rule 2014 on 30th June 2014, which was further amended by through company's cost audit and cost records and audit amendment rule 2014 and have made made effective from 31st December 2024. The rules were were further amended subsequently. The rule has divided the list of companies required to maintain the cost records into two categories: regulatory sector and non-regulated sector. Uh, Regulated sector includes industries, product sectors like telecommunication services, then generation, transmission, distribution, and supply of electricity, petroleum product, including activities regulated by petroleum and natural gas, drugs and pharmaceuticals, fertilizers, and sugar and industrial alcohol. Uh, then non-regulated sector, uh, machinery and mechanical appliances, turbojets, turbopropellers, arms and ammunitions, propellant, powder, prepared explosives, safety fuses, radar apparatus, and many other are there in the non-regulated sector as well. Here is a detailed list that has been provided. Now, the provisions are like this. Application of cost records, Rule 3. Rule 3 of the company's cost record and audit rules 2014 provides that all companies under regulated and non-regulated list engaged in the production of goods or providing services having an overall turnover from all the products and services of rupees 35 crore or more during the immediately preceding financial year are required to include cost records in their books of accounts. These companies shall also include foreign companies defined in subsection 42 of section 2 of the act, but it excludes a company classified as a micro enterprise or small enterprise as per turnover criteria provided under micro and small medium enterprise development 2026. This chart is important. First of all, applicability for maintenance of cost records, domestic as well as foreign company. For both type of companies it is applicable, and as per rule 3 there are two lists, regulated and non-regulated. On regulated and regulated who are engaged in the production of goods or services, providing services, and overall turnover from all these product services are greater than equal to 35 crore, they are required to maintain the cost records. Then cost audit applicability. Every company specified in A of the rule 3 shall also get its cost records audited in accordance with these rules if the overall annual turnover of the company from all its products and services during the immediately preceding financial year is rupees 50 crore or more, and the aggregate turnover of the individual product or products or services for which cost records are required to be maintained under rule 3 is rupees 25 crore or more. The aggregate turnover 45 crore more and individual 25 turnover crore or more. Every company specified in item B of the rule 3 shall get its cost records audited in accordance with these rules if the overall annual turnover of the company from all the products and services during the immediately preceding financial year is rupees 100 crore or more, and the aggregate turnover of individual products or services for which the cost records are maintained to be required to be maintained under rule 3 is rupees 35 crore or more. The requirement for cost audit under this rule shall not apply to companies which are covered in rule number 3. and whose revenue from exports in foreign exchange exceeds 75% of the total revenue, or which is operating from a special economic zone. And finally, which is engaged in generation of electricity for captive consumption through captive generating plant. So this is actually the audit cost audit requirement rule as per rule 4. Here you can see that the two sectors in which we are dividing the companies. For regulatory and non-regulatory sector. For regulatory sector, we are mentioning that when the overall annual turnover during immediately preceding financial year is greater than equal to 50 crore, and aggregate turnover of individual product is greater than equal to 25 crore, cost audit is required. If the revenue from export foreign exchange 75% of the total revenue, or operating from special economic zone, or if revenue from export is greater than 75% of the total revenue, and if operating from the special economic zone, then rule 4 shall not apply, only rule 3 shall apply. And for non-regulatory sector, overall annual turnover, if it is greater than equal to 100 crore and aggregate turnover for individual product is greater than equal to 35 crore, then cost audit is necessary. Section 148(4) of the Companies Act 2013 further states that an audit conducted under this section shall be in addition to the audit under 140. That is, cost audit is in addition to the statutory audit. Maintenance of records, Rule 5. Now, every company under these rules, including all units and branches thereof, shall, in respect of each of its financial year commencing on or from 1st April 14, maintain cost records in CRA 1. Provided that in case of a company covered in the serial number 12 and serial number 24 to 32 of item B of Rule 3, that is non-regulated sector, the requirement under this rule shall apply in respect of each of the financial year commencing on or after 1st day of April 2015. The cost records referred to in sub-rule 1 shall be maintained on a regular basis in such manner as to facilitate calculation of per unit cost of production or cost operations, cost of sales, marginal and margin for each of the product and activities for every financial year on monthly or quarterly or half yearly or annual basis. The cost record shall be maintained in such manner so as to enable the company to exercise, as far as possible, control over the various operations and costs to achieve optimum economies in utilization of resources, and those records shall also provide necessary data which is required to be furnished under this rules. Now, appointment of cost auditor, Rule 6. As per Section 148, subsection 3 of the Companies Act 2013, cost audit shall be conducted by cost accountant, who shall be appointed by the board. No person appointed under Section 139 as company auditor shall be appointed for conducting the audit of cost records. The auditor so appointed shall comply with the cost accounting standard. Further, Rule 6 also states the following. First of all, the category of companies specified in Rule 3 and the threshold limit laid down in Rule 4 shall, within 180 days of the commencement of every financial year, appoint a cost auditor, provided that before such appointment is made, the written consent of the cost auditor to such appointment and a certificate from him or it, as provided in sub-rule 1A, shall be furnished. Next, the cost auditor appointed under sub-rule 1 shall submit a certificate that the individual of the firm, as the case may be, he is eligible for appointment and is not disqualified for appointment under the Act, the Cost and Works Accounts Act 1959, and the rules of the regulation made thereunder. The individual or the firm, as the case may be, satisfies the criteria provided in Section 141 of the Act, so far as may be applicable. The proposed appointment is within the limits laid down by or under the authority of the Act, and the list of proceedings against cost auditor or audit firm or any partner of the audit firm pending with respect to professional matters of conduct as disclosed in the certificate is true and correct. Next, every company referred to in sub-rule 1 shall inform the cost auditor concerned of his or her or its appointment as such, and file a notice of such appointment with the central government with a period of 30 days of the board meeting in which the appointment is made, or within a period of 180 days of the commencement of the financial year, whichever is earlier, through electronic mode in Form CRA2, along with the fees as specified in Companies Registration Officers and Fees Rule 2014. Now, every cost auditor appointed as such shall continue in such capacity till the expiry of the 180 days from the closure of the financial year, or till he submits the cost audit report for the financial year for which he has been appointed. However, cost auditor appointed under these rules may be removed from his office before the expiry of the term through a board resolution after giving a reasonable opportunity of being heard to the cost auditor, and uh, regarding the reasons for which removal is writing. Removal is in writing. Provided further that Form CRA2 to be filled up with the central government for intimating appointment of another cost auditor shall enclose the relevant board resolution to the effect, and provided also that nothing contained in the sub-rule shall prejudice the right of the cost auditor to resign from such office of the company. Now, any casual vacancy in the office of the cost auditor due to resignation, death, or removal shall be filled by the board of directors within 30 days of the occurrence of such vacancy, and the company audit, and the company shall refrain from central government in Form CRA2 within 30 days of such appointment of cost auditor. The cost statement, including other statements to be annexed to the cost audit report, this should be attached with the cost audit report, shall be approved by the board of directors before they are signed on behalf of the board by any of the directors authorized by the board for submission to the cost auditor to report thereon. And obviously, the cost auditor will submit the same to the central government. In the case of the companies which are required to constitute an audit committee, the board shall appoint an individual who is a cost accountant or a firm of cost accountants in practice as cost auditor on the commencement of the audit, or on the recommendation of the audit committee. Next, disqualification of cost auditor. Persons disqualified under section 141 subsection 3 shall not be appointed as cost auditor of the company. Similarly, auditor of a company appointed under section 139 shall not act as the cost auditor of the company. That is, company auditor cannot be the cost auditor. Remuneration of cost auditor as per section 148 subsection 3 of the Companies Act 2015, read with Rule 14 of the Companies Audit and Auditor Rule 2014. The remuneration of the cost auditor shall be decided by the board as recommended by the board as recommended by the audit committee, if any, which shall be rectified by the shareholders subsequently. In the companies which are not required to constitute an audit committee, the board shall appoint an individual who is a cost accountant or a firm of cost accountant in practice as cost auditor, and the remuneration of such cost auditor shall be ratified by the shareholders subsequently. Then what should be the rights and duties? The rights, duties, and obligations as applicable to the company auditor shall also apply to the cost auditor under section 148, and it shall be the duty of the company to give all assistance and facilities to the cost auditor appointed under this section for auditing the cost records of the company. Next, submission of cost audit report. As per section 148(5) of read with Rule 6 of the Company's Cost Records and Audit Rules 2014, every cost auditor who conducts a cost audit of a company shall submit the cost audit report along with his or her observation or qualification, observation or suggestion, if any, in form number CRA3. The cost auditor shall forward his duly signed report to the board of directors of the company within a period of 180 days from the closure of the financial year to which the report relates, and the board of directors shall consider and examine such report, particularly any reservations or qualification contained therein. The company covered under these rules shall, within a period of 30 days from the date of receipt of the copy of the cost audit report, furnish the central government with such report along with full information and explanation on every reservation or disqualification contained therein in Form CRA4 in extensible business reporting language, that is XBRL format, in the manner as specified in company's filling of documents and forms in XBRL Rules 2015, along with the fees specified in the company's registration officers and fees rules 2014, provided that companies which uh, have got extension of time of holding annual general meeting under section 96 subsection 1 of the Companies Act 2013 may file form CRA4 within the resultant extended period of filing financial statement under section 137 of the Companies Act 2013. If the central government is of the opinion that any further information or explanation is required, it may call for such further information and explanation, and the company shall furnish the same within such time as may be prescribed by the government. Next, forms relevant. Companies cost audit and cost records and audit rules 2014 provides for 4 different forms for separate purposes. CRA 1 for the manner in which cost records shall be maintained. CRA 2 for intimation of appointment of cost auditor by the company to central government. CRA 3 for cost audit report, and CRA 4 for filing of cost audit report to the central government. For filing the cost audit report with the central government. Then penal provision of in case of default. According to section 148, subsection 8, while complying with the aforesaid provision, if any default takes place on the part of the company shall be punishable with fine between 25,000 and 5 lakh, and every officer of the company who is in default shall be punishable with imprisonment for a term which may extend to 1 year or fine between 10,000 and 1 lakh. And secondly, the cost auditor of the company who is in default shall be punishable in the manner as provided in subsection 2 to 7, 2 to 4 of the subsection of section 147. Reporting requirements of cost audit as per CRA 3. As per company's cost audit and cost records and audit rules 2014 as amended up to date, the cost auditor needs to report the following in CRA 3 form: whether he has obtained all the information and explanations which to the best of his knowledge and belief were necessary for the purpose of audit. Secondly, whether in his opinion proper cost records as per rule 5 of the company's cost records and audit rules 2014 have been maintained by the company in respect of product or services. Whether in his opinion proper returns adequate for the purpose of the cost audit have been received from the branches not visited by him. Whether in his opinion and to the best of his information, the said books and records give the information required by the company of 2013 in the manner so required. Whether in his opinion the company has adequate system of internal audit of cost records, which to his opinion is commensurate with the nature and size of the business, and whether in his opinion information statements in the annexure to the cost audit report give a true and fair view of the cost of production of product or rendering services, cost sales, margin, and other information relating to product service under reference. And whether detailed unit wise and product wise, service wise cost statements and schedules thereto in respect of the product or service of the company duly audited by or certified by him are kept by in the company. In this context, let us consider one case study. Suppose Mr. P is the cost was the cost auditor of ABC Limited, was appointed for the financial year 2021, has resigned due to some personal reasons. As per the provision of the Companies Act 2013, the company is required to constitute an audit committee. ABC Limited has asked for your opinion as the legal expert regarding the process of filling up of vacancy created. advise ABC Limited on required course of action. Now, Rule 6 of the Company's Cost Records and Audit Rule 2014 states that any casual vacancy in the office of a cost auditor, whether due to resignation, death, or removal, shall be uh, filled by the board of directors within 30 days of the occurrence of such vacancy, and the company shall inform the central government in the form of CRA 2 within 30 days of such appointment. In the given case, the vacancy arising out of the resignation of cost auditor is a casual vacancy. Hence, BOD, after recommendation from the audit committee, so existing, shall appoint the cost auditor within 30 days of the occurrence of such vacancy, and the company shall inform the central government in form number CRA 2 within 30 days of such appointment of the cost auditor. Let us consider one relatively small topic because we don't have sufficient time. Um, Let us have an overview of this one, secretarial audit, and if possible, we will be starting our discussion from this particular point onwards in the next class. Now, regarding secretarial audit, let us start with the applicability. Companies Act 2013, as per provision 200 section 204 subsection 1 of the Companies Act 2013, read with Rule 4, Rule 9 of the Companies Appointment and Remuneration of Managerial Personnel Rule 2014. Every listed company, every public company having a paid up capital of 50 crore rupees or more, or every public company having a turnover of 250 crore or more, or every company having outstanding loan or borrowing from bank or public financial institution of 100 crore or more, for them the secretarial audit is compulsory. Is required to annex with this with the board report made in terms of section 134(3) of the Companies Act 2013, a secretarial audit report given by the company secretary in practice in form MR3. As per section 2042, it shall be the duty of the company to give all assistance and facilities to a company secretary in practice for auditing the secretarial and related records of the company. Moreover, section 2044 further provides that if a company or any officer of the company or the company secretary in practice contravenes the provisions of this section of company, every officer of the company or the company secretary in practice who is in default shall be liable to a penalty of 2 lakh rupees. Apart from Companies Act, there are certain SEBI regulation in this context also. As per Regulation 24A of the SEBI LODR Regulation 2000, every listed company and its material unlisted subsidiaries incorporated in India shall undertake secretarial audit and shall annex a secretarial audit report given by a company secretary in practice in such form as specified with annual report of the listed company. In addition to the above, every listed entity shall submit a secretarial compliance report in such form as specified to the stock exchange uh, within 60 days from the end of the financial year, amended by the SEBI listing regulation and disclosure requirements, second amendment regulation 2021 with effect from 5th May 2021. Qualification of a secretarial auditor. According to the provision of section 204, only a member of the Institute of Company Secretaries of India holding a certificate of practice is qualified to conduct secretarial audit of the company. Now, appointment. As per Rule 8 of the company's meeting of board and its power, Rule 2014, read with Section 179 of Companies Act 2013, secretarial auditor is required to be appointed by means of a resolution at a duly convened board meeting. It is advisable for the secretarial auditor to get a letter of engagement from the company. Secretarial auditor should accept the letter of engagement. The company shall report any change in the secretarial audit during the financial year to the members through the board's report. The qualifications, observation, or comments, remarks of the secretarial audit report shall be read at the annual general meeting of the company, along with the explanation and comments of the board of directors. Secretarial audit report. Section 204 of the Companies Act 2013 provides that secretarial audit report is to be submitted in a format prescribed under rules as per sub-rule 2 of Rule 9 of the Company's Appointment and Remuneration of the Managerial Personnel, Rules 2014. The format of the secretarial audit report shall be in form number MR3, Section 134 and subsection 3 of Section 204 further provides that Board of Directors in its report shall explain in full any qualification or observation or other remarks made by the company secretary in practice in the secretarial audit report. In addition, Regulation 24A of the SEBI LODR Regulation 2015 requires that every listed entity and its material unlisted subsidiaries incorporated in India shall undertake secretarial audit and shall annex a secretarial audit report given by the company secretary in practice in such form as specified with the annual report of the listed entity. Every listed entity shall submit a secretarial compliance report in such form as specified to stock exchanges within 60 days from the end of the financial year. SEBI, by its circular dated February 8, 2019, notified the formats of annual secretarial audit report and annual secretarial audit compliance report for listed entities and material subsidiaries effective from the financial year 31st March 2019. So, in our today's class, we have discussed certain topics from module number 7. Primarily, our objective was to complete at least 50% of the total syllabus coverage of this module 7, because we have one more class in the coming 23rd May. So in that particular class, rest of the topic from this module 7 and if possible module 8 also we shall cover. Now, with regard to our today's discussion, if you have any query, then you can mention the same in the chat box, or you can unmute your mic and ask me the same. If there is anything to discuss, any query that you have. As an alternative, you can also mail me. I'm just typing my mail ID in the chat box. It is shopun22@gmail.com. So during your preparation also, if you have any query, then you can mail me. I will be happy to help. Almost we have come to the end of our class. So let us conclude here now. I am ending the presentation. I think you don't have any query at this point of time. So let us hope that you will be preparing for your examination well, and based on this discussion, based on these classes, which you can access from the archive also, you what are the important areas that we have discussed, and accordingly you prepare yourself. And obviously I will also suggest that you consider the previous term question paper. That will give you a lot of idea regarding what is the trend of the question paper under the current syllabus. With that, let us conclude. Thank you very much.